Here's something that'll blow your mind. The average American investor earns about half of what the stock market actually returns. Wait, how's that even possible? The S&P 500 has averaged around 10% per year for decades, but the average person clicking buy and sell on their Robinhood app, they're lucky to see 5%. And here's the kicker, it's not because the market is rigged against you. It's because most people make investment decisions with their emotions instead of their brains. They panic when stocks drop 10%. They sell everything. Then, 6 months later, after the market's already recovered, they buy back in at higher prices. And they do this over and over again. Finance nerds have a term for this disaster, the behavioral gap. And it's the single biggest reason why people with good jobs and decent savings end up retiring broke. But here's the good news. Once you understand how funds actually work, index funds, mutual funds, ETFs, you'll never fall into that trap again. By the end of this video, you're going to know more about investing than 90% of people. You'll know exactly where to put your money. And you'll finally get why Warren Buffett made a $1 million bet against Wall Street's best fund managers and crushed them. So let's dive in. What is a fund? Before we talk about types of funds, let's nail down what a fund actually is. Picture this. You and 9 friends want to throw an epic rooftop party in New York City. But none of you can afford to rent the space, hire the DJ, or pay for catering on your own. So you all throw in $200. Now you've got $2,000. Suddenly, you can make something incredible happen. You hire someone to handle all the logistics, everyone shares in the success, and nobody had to drain their bank account. That's exactly how a fund works. It's a big pot of money from hundreds, sometimes millions of people. That money gets invested in stocks, bonds, real estate, whatever. You're not managing it yourself. Someone else does the heavy lifting. You just share in the results. Simple enough, right? Cool. Now let's break down the different types, starting with the one that changed investing forever. Index funds are the set it and forget it option of investing. They don't try to beat the market. They are the market. Here's how it works. An index fund copies a list of companies. That list is called an index, like the S&P 500, which tracks the 500 biggest companies in America. Apple, Microsoft, Nvidia, they're all in there. The fund buys a tiny piece of all of them. So when you invest in an S&P 500 index fund, you're literally buying a slice of the entire US economy. No guessing which stock will pop next, no panicking when Tesla drops 20%. Just smooth, steady exposure to corporate America. In 2007, Warren Buffett, one of the greatest investors alive, made a bet that shocked Wall Street. He wagered $1 million that a simple S&P 500 index fund would beat a hand-picked group of hedge funds over 10 years. Hedge funds, by the way, are managed by some of the smartest financial minds on the planet. They charge massive fees. They use complex strategies. They're supposed to be the elite. But Buffett said, nah, a basic index fund will destroy them. And guess what happened? The index fund returned 125.8% over that decade. The hedge funds? Between 2.8% and 87.7%. Most of them got crushed. Even during the 2008 financial crisis, when the S&P 500 dropped 37%, the index fund still won over the long run because it didn't panic. It didn't try to outsmart the market. It just stayed invested. Now here's where things get wild. Studies show that if you miss just the 10 best days in the stock market over a 20-year period, your returns get cut in half. Let me say that again. Missing 10 days out of over 5,000 trading days destroys your wealth. And here's the brutal part. Those best days usually happen right after the worst days. When the market crashes and everyone's freaking out, that's when the biggest rebounds happen. So when people panic sell during a downturn, they miss the recovery. That's the behavioral gap in action. Let's put some real numbers on this. Say you invest $10,000 in an S&P 500 index fund on January 1st, 2005. You leave it untouched through the 2008 crash, the COVID panic, everything. By the end of 2024, you'd have around $71,750. That's a 10.4% annualized return. But if you missed the 10 best market days, your balance drops to $32,871. You'd only make 6.1% per year. Miss the best 60 days? You'd actually lose money. Your $10,000 would be worth less than $5,000. This is why time in the market beats timing the market isn't just a cute phrase. It's math. Let's get even more specific. Say you invest $10,000 and just leave it in an S&P 500 index fund, earning 10% per year, the historical average. After 10 years, around $26,000. After 20 years, around $67,000. After 30 years, around $174,000. You didn't pick stocks, you didn't watch CNBC every day, you didn't panic sell, you just stayed invested. That's the power of compounding. And index funds make it automatic. Oh, and fees? Laughably low. Most index funds charge between 0.03% and 0.20% per year. So if you invest $10,000, you're paying $3 to $20 annually. Compare that to actively managed funds charging 1% or more. Over 30 years, that 1% difference could cost you tens of thousands of dollars in lost gains. Companies like Vanguard, BlackRock, iShares, and Fidelity all offer top-tier index funds. In 2024 alone, the Vanguard Growth Index returned 34.2%. The Vanguard 500 Index, up nearly 25%. These aren't flashy, they're not sexy, but they work. Now let's talk mutual funds. At first glance, they seem similar to index funds. They pool money from a bunch of investors and spread it across different assets. But here's the key difference. Mutual funds are actively managed. That means there's a professional fund manager or an entire team making decisions. They're researching companies, placing bets, trying to outsmart the market. The goal? Beat the S&P 500. Sounds great, right? Someone smart managing your money for you? Here's the problem. Most of them fail. Let me hit you with some stats that Wall Street doesn't want you to see. Over a 10-year period, about 85% to 90% of actively managed funds underperform their benchmark. Let me repeat that. 9 out of 10 professional fund managers can't beat a simple index fund over 10 years. After 15 years, that number climbs to 92%. Almost nobody beats the market long term. And get this, in 2024, over 64% of large-cap mutual funds lagged the S&P 500. Even in a banner year for stocks, most pros couldn't keep up. It's not that fund managers are dumb. They're not. They have advanced degrees, massive research teams, and cutting-edge tools. The problem is threefold. Fees eat returns. Most mutual funds charge between 0.5% and 1.5% per year. Some even higher. Those fees compound against you. They can't all win. If everyone's trying to beat the market, most will end up average, or worse, after fees. Emotions still matter. Even pros make mistakes. They chase trends, they panic, they hold losers too long and sell winners too early. That said, mutual funds aren't pure evil. Some people like them because they want exposure to specific sectors, like healthcare, emerging markets, or small-cap stocks that aren't easily accessible through basic index funds. And if you find a mutual fund with a stellar long-term track record and reasonable fees, It could make sense. Just go in with your eyes open. You're probably paying more to get worse results. All right, now we're entering the big leagues. Hedge funds. Hedge funds are not for regular people. They're for the ultra-wealthy, millionaires, billionaires, institutions. Why? Because hedge funds use aggressive, high-risk strategies to try to generate massive returns. We're talking short selling, betting stocks will go down. Leverage, borrowing money to invest even more. Derivatives, complex financial instruments most people don't understand. It's like the difference between playing poker at your buddy's house and sitting at a high-stakes table in Las Vegas with professionals who've memorized every card. Hedge funds can make huge gains, but they can also blow up spectacularly. And the cost? Brutal. Hedge funds typically charge what's called 2 and 20, 2% per year just for managing your money, plus 20% of any profits. So if the fund makes $1 million, they're taking $200,000 off the top. That's why they need to deliver big returns, or it's just not worth it. According to a study by LCH Investments, since hedge funds were invented in 1969, investors have paid nearly half of their profits as fees. Half. Let that sink in. Unless you're sitting on millions and can afford to lose a big chunk, hedge funds aren't for you. And honestly, most people don't need them. Remember Buffett's bet? The pros, with all their fancy strategies, got crushed by a boring index fund. ETFs, exchange-traded funds, are like the cool younger sibling of index funds. They work almost the same way. Track an index, give you diversification, keep fees low. The big difference? ETFs trade like stocks. With traditional index funds, you place an order and it gets processed after the market closes at 4 p.m. You don't know the exact price until then. With ETFs, you can buy and sell any time during the day, and the price changes in real time. You have instant control. ETFs are flexible, cheap, fees usually between 0.03% and 0.75%, and super accessible. Most brokerage platforms let you buy them with zero commission. Want to invest in the S&P 500? There's an ETF for that, like SPY or VOO. Want exposure to tech? There's QQQ. Clean energy? Yep, there's an ETF. In 2024, the Invesco QQQ returned over 25%. The SPDR S&P 500 ETF? About 24.9%. Solid, consistent performance. For most people, ETFs and index funds are basically interchangeable. Pick whichever fits your style. Let's talk about a word you've probably heard a million times: diversification. It just means don't put all your eggs in one basket. When you invest in an index fund or ETF, you're spreading your money across hundreds of companies. So if one company tanks, like if Tesla drops 40%, it doesn't destroy your whole portfolio. And here's why that matters. Diversification doesn't just reduce risk, it reduces emotional panic. When the market drops and you see your account go red, diversification is what keeps you from freaking out and selling everything. It keeps you in the game long enough to win. Mark Cuban, billionaire investor and Shark Tank guy, has said that for most people, a low-cost S&P 500 index fund is the smartest move. Keep 90% of your money there. If you want to take a flyer on something risky, fine, limit it to 10%. Remember that stat I mentioned earlier? 85% to 90% of professional fund managers fail to beat the market over 10+ years? Think about that. These are people with teams of analysts, advanced degrees from Harvard and Wharton, millions of dollars in resources, access to information you and I don't have, and they still can't beat a simple index fund. Why? Because at the end of the day, investing isn't about being the smartest person in the room. It's about being the most disciplined. The pros try to be clever. They trade constantly, they chase trends, they pay high fees. They make emotional decisions under pressure from clients. Meanwhile, the index fund investor, they do nothing. They just sit there. And over time, doing nothing wins. So here's what you need to walk away with. Staying invested beats constantly guessing. The people who win at investing aren't the ones frantically trading. They're the ones who invest consistently, stay diversified, and don't panic when things get rocky. Diversification keeps you alive long enough to win. Spread your money across the market. Let the ups and downs average out. Long-term thinking beats emotional panic. The behavioral gap is real. But now that you know it exists, you can avoid it. Index funds and ETFs, they're boring, they're simple, and they work. You don't need to be a genius. You don't need a finance degree. You just need to put your money in, leave it alone, and let compounding do its thing. That $10,000 you invest today, in 30 years at 10% per year, it could be worth $174,000 just by sitting there. That's the power of patience. That's the power of index funds. If this finally made investing click for you, smash that like button and subscribe so you don't miss the next one. This is the Money Introduction channel. I'm going to drop another video right here that dives even deeper into building wealth from scratch. Thanks for watching. Now go build some generational wealth.